The recent interest rate hikes keep exposing pressure cracks, and water is leaking everywhere, from hyper-leveraged companies and governments to households struggling with mortgages. What's more, banks are suddenly seeing how large holes are opening up in their balance sheets, sometimes even leading them to bankruptcy. Are we on the verge of financial crisis? We'll talk about that topic in a future video, but for now, in this one, we will tell you how, once upon a time, the banks agreed amongst themselves to cheat half the world and make billions and billions of dollars in the process. When you go to apply for a mortgage, you have two options. One is to choose a fixed rate, so that every year you will pay the bank the same interest rate no matter what happens. The other option is to choose a variable rate. That is to say, there will be months when you will pay higher interest rates, and there will be other months when they will be lower. The question is, what exactly does the cost depend on? That is, the rate you will have to pay for a variable mortgage. Why does the cost of the mortgage change over time? Well, in this case, the cost of your variable mortgage will depend on the interest rate at which the banks lend money to each other. That is to say, if the banks lend each other money at a cheaper rate, your mortgage will be lower. If, on the other hand, they lend each other money at higher rates, your mortgage will also be more expensive. Well, the interest rate at which banks lend to each other is known thanks to some indicators, which I am sure most of you have heard of. I am referring to the Euribor, if you are watching us from Europe, or the LIBOR, if you're watching from another part of the world. These indicators are calculated by means of surveys. Let's say that every day in the morning, a man calls the banks and asks them, "Hey, what interest rate do you think the rest of the banks would lend you money at before the end of the morning?" Then the banks respond, and once everyone has responded, a truncated average is made. And hey presto, there you have it. That average will be the LIBOR, or Euribor of the day, a reference that will be published mid-morning in all the media outlets. The funny thing is that in these surveys, the banks are completely free to give any answer they deem appropriate. That is, they do not need to provide a single document certifying that what they say is true. Nothing, absolutely nothing. Or at least that was the case until a few years ago, until it was discovered that banks had been massively manipulating LIBOR surveys for their own benefit. And I know what you're thinking. Of course, the banks manipulated LIBOR to raise the interest rate on variable mortgages to make more money at everyone's expense. Seems like a no-brainer, right? Well, let's not jump to conclusions. The data tell us something quite different, mainly that the banks manipulated the LIBOR to reduce it. And the question is, why? What on earth did the financial institutions gain by making mortgages cheaper? What were their hidden interests? Why are we saying that this harmed thousands and thousands of people? In this video, Visualeconomik viewers, we are going to tell you about the biggest bank manipulation in history, the LIBOR manipulation. Listen up. In the mid-1980s, global banking realized it had a problem. There were more and more banks, more and more financial products, and more money circulating everywhere. However, what they did not have were good references. That is, the market was skewed. Financial institutions did not have a good approximation of the level of liquidity in the market, and to a certain extent, this made them work blind. In other words, it was very difficult for them to negotiate and reach an agreement with the rest of the banks. Each operation had become a real odyssey. Interest rates changed course every day, sometimes abruptly, or even going in opposite directions. They changed depending on the type of loan, the sentiment of the time, or the location of the bank lending the money. There was a need for a solution that would improve market efficiency. And guess what? That's when the British Banking Association, or BBA for short, came up with an idea. How about making an index that captures the average market interest rate and publishing it every day? Well, no sooner said than done. On 1st of January 1986, LIBOR was published for the first time in history. The BBA defined it as follows.
LIBOR is the interest rate at which a bank can borrow funds from another bank before 11 a.m. London time.
Thanks to this measure, banks no longer had to negotiate ad nauseum to reach an agreement when lending money to each other. They only had to look at the LIBOR of the day and use it as a reference for their loans. The index was a success, and over time, LIBOR became increasingly popular. In fact, it became so popular that it is still used as a benchmark measure around the world today. It has even been imitated in Europe with the well-known Euribor. In short, the creation of LIBOR made life much easier for banks and improved the operation of the financial system. It had been a complete success, or at least it was until 2008.
The 16th of April 2008, bankers cast doubt on key rate amid crisis. Broken indicator? Since the financial crisis began, the rate on 3-month interbank loans has diverged at times from the comparable rate for dollars deposited outside the US.
And so, a few months after the outbreak of the financial crisis, something about LIBOR was starting to smell fishy. According to the Wall Street Journal article we just showed you, it appeared that LIBOR was reporting suspiciously lower rates than it should have been compared to other similar indicators. Of course, the British Banking Association did not hesitate to defend the validity and veracity of LIBOR, which it said was a great instrument even in the worst periods of crisis. And of course, the defense of LIBOR did not end there. A few weeks later, the Bank for International Settlements, which is something like the father of all central banks, released a statement saying that there was not a single piece of evidence that LIBOR was being manipulated. In other words, it was all unfounded conspiracy theories. However, well, we do not even know how to tell you what comes next because it's actually surreal. Imagine the enormous international ridicule when only 2 months after the first article that sowed doubts and after all the international organizations threw themselves into defending LIBOR, the Wall Street Journal publishes this graph. Yes, you can see it perfectly. On the very day that the banks were accused of manipulating LIBOR downwards, they had the genius idea of suddenly raising it again. To make it look like as if nothing had happened. And the question is, did it work for them? Not at all, quite the contrary. From 2008 onwards, a huge media and investigation process began that ended up pushing many banks to the limit. It was then cornered like a helpless puppy and hoping for a reduction in the fine for confessing and turning themselves in voluntarily that Barclays Bank decided to open its mouth and tell on everyone.
Barclays Bank plc admits misconduct related to submissions for the London Interbank Offered Rate and the Euro Interbank Offered Rate and agrees to pay $160 million penalty. Department of Justice of United States of America, 27th of June 2012.
The banks that participated in the development of LIBOR had formed nothing less than a cartel to modify it at will and thus increase their profits. So then the question is, but how much money were they able to make from that? Well, it is not easy to pinpoint, but to give you an idea, a 2009 Citibank report showed that by reducing LIBOR by 1%, up to 2 billion euros could be earned in a single stroke. 2 billion euros for a single bank in a single 4-month period. But how on earth could a bank make so much money by lowering interest rates? What was the mechanism of the scam? Well, let's take a look.
The Time Bomb.
One of the most striking things about LIBOR manipulation is that it became so evident just after the 2008 crisis. That is, they had plenty of time to alter LIBOR since its inception in the 1980s. Yet all the evidence found pointed to the fact that the manipulation was most intense at the height of the financial bubble. And it turns out that this was not a coincidence. Do you remember how LIBOR was calculated? The question they asked the banks to calculate it? These indicators are calculated by means of surveys. Let's say that every day in the morning, a man calls the banks and asks them, hey, what interest rate do you think the rest of the banks would lend you money at before the end of the morning? Then the banks respond. And once everyone has responded, a truncated average is made. And hey presto, there you have it. Exactly, the banks were asked what was the interest rate at which the other banks would lend them the money. And here's the interesting thing. If a bank said that other banks were charging it a very high interest rate, it was implicitly confessing that it was not a trustworthy bank, that nobody wanted to lend it cheap money because there was a risk that it would end up defaulting. And of course, in times of crisis, implying that you are not a particularly safe bank is not the best idea if you want to keep your customers. So to avoid that, they inflated the LIBOR surveys just a bit. But that is just the tip of the iceberg. As I explained earlier, by lowering interest rates, banks were able to make billions in extra profits. But how did they do it? Well, you see, despite the fact that we see banks as entities, dedicated simply to lending money and keeping our savings, banks are also dedicated to investing in companies, in treasury bonds, or in other more complex financial products such as swaps. And it is precisely in these types of investments where a drop in interest rates could translate into great profits. You see, imagine, for example, that a company has a debt, and that debt is indexed to a LIBOR equivalent to 3%. However, LIBOR is a changing indicator. If things go very badly, the LIBOR could go up to 10%, for example. And in that case, the company would have great difficulty paying its debt and would run the risk of bankruptcy. The question is, what could the company do to protect itself from an unexpected LIBOR rise? Well, it could enter into a deal called a swap with the bank. With this swap, the bank can offer a fixed rate loan of 6% to the company in exchange for its loan indexed to LIBOR at 3%. And so the company will pay a fixed 6% to the bank, and the bank will pay the 3% LIBOR-linked debt for the company. With this operation, and as long as the LIBOR does not vary too much, the bank will receive 6% and will only have to pay 3%. So it will end up making a lot of money. And notice, the lower the LIBOR, the more money the bank will make. For example, if LIBOR drops to 1%, the company will still pay 6% to the bank, but the bank will only have to pay 1% of the variable debt. In other words, with a LIBOR 2 points lower, the bank will earn 2 points more. The perfect deal. Do you now see a little more clearly why it was in the bank's interests to lower LIBOR? Of course, to be more rigorous, we have to note that swaps were not the only mechanism by which banks could make money by manipulating LIBOR. On certain occasions, they could also benefit if they raised it. In any case, the conclusion is that the banks made a lot, and I mean a lot, of money, manipulating the market and swindling others. Right now, you're probably wondering, so what happened when the whole ruse was discovered? Why are LIBOR and Euribor still being used today if they are so dodgy? Is it possible that it could all happen again? Well, let's see.
The patch holding back disaster.
After the LIBOR scandal came to light, banking institutions and regulators had to take action. They could not let LIBOR continue to operate in the same way. They could not allow the manipulation to happen again. And among all the measures that were taken, the most important was the following.
British Bankers Association to be stripped of LIBOR rate setting role. Banking lobby group will be replaced by formal regulator following scandal that led to departure of Bob Diamond.
Indeed, as of 2014, the calculation of the LIBOR rate came to be managed by an operator that, unlike the BBA, is completely external to British banking, NYSE Euronext. This new operator, in addition to performing the LIBOR calculation functions already performed by the BBA, has had the capacity and duty to verify that the data provided by the banks are real. Therefore, among its powers and obligations are included periodic inspections of the banks to verify that they are not lying, and the publication of detailed statistical reports to guarantee the security and reliability of LIBOR. And now comes the million-dollar question. Did it solve the handling problems? Well, according to scientific research by economist Aurelio Barrivera, that will link for you in the description. From that moment on, the levels of manipulation ceased, and everything returned to normal before the crisis. In any case, whether you trust these indicators or not now that you've seen how they work, the truth is that their time is coming to an end.
17th of May 2021, the administrator for LIBOR and other interbank offered rates, ICE Benchmark Administration, IBA, confirmed on 5th of March 2021 its previously announced dates for LIBOR cessation.
The new indicators, based on real data and not on surveys, seem to be here to stay. Specifically, the SOFR, which will replace LIBOR, began to be used progressively at the end of 2021, and its adoption is expected to be completed by the end of 2023. In other words, we will no longer have to worry about whether the banks will be playing tricks with the reference rates again, at least as far as LIBOR is concerned, because in Europe, Euribor still has a long life ahead of it. But now the questions are over to you. Did you think that the LIBOR catastrophe was coming? Why didn't anyone realize it until it was too late? What would you do so that the banks could not take advantage of market weaknesses? You can leave me your answers in the comments, and as always, don't forget that here on Visualeconomik, we release new videos every week. So subscribe to this channel, hit the little bell so you don't miss any of our updates, and if you liked the video, hit like, and I'll see you in the next one. Take care, see you next time.